If you're a long-term investor, the goal is pretty straightforward, right? You want to create wealth. But getting there, that's the tricky part. So let's dive into this. How do you actually find the companies that are going to grow your money for the long haul? And this right here, this is the billion-dollar question. I mean, for every amazing success story you hear about, there's another cautionary tale, a stock that just completely wiped people out. If you make the right choice, you're on a path to incredible growth. But if you make the wrong one, well, the consequences can be pretty devastating. And look, this isn't some textbook theory. These are real-world examples from the Indian market. Over on one side, you've got the absolute wealth creators, companies like TCS and Eicher Motors that have just delivered staggering returns over the years. And on the other side, the wealth destructors. Suzlon Energy, Reliance Power. Their stock charts tell a very, very different story. The real challenge, of course, is figuring out how to spot the winners from the very beginning. So what's the big deal with those companies on the left? Well, many of them have delivered returns at or even above this magic number 20%. We're talking about the compounded annual growth rate, or CAGR. Think of it as the average speed at which your investment grows, year in and year out. And this is where the magic of compounding really kicks in. When you're hitting a consistent 20% CAGR, you're literally doubling your money about every 3.5 years. And the higher that rate, the faster your wealth just explodes. I mean, some companies like Bosch India have even gotten close to a 30% CAGR. The potential is just massive. Okay, so the mission is clear, right? We want to find these companies that can compound our money at 20% or more. But how do we do it? What's the secret? How do we spot the signs of a wealth creator long before the rest of the market catches on? Well, the answer, the secret sauce, if you will, is a technique called fundamental analysis. This is the playbook that savvy long-term investors live by. It's all about tuning out the daily noise, the headlines, the market panic, and focusing on what really matters, the underlying health and potential of the business itself. Because at the end of the day, a strong business is what drives a stock's value up over the long term. Okay, I know exactly what some of you are thinking right now. Fundamental analysis. Whoa, that sounds really complicated. Isn't that for, finance pros and chartered accountants? It's a super common thought, but honestly, it's also a huge misconception. Yeah, check out this quote. It just blows that myth right out of the water. You absolutely do not need a fancy degree or a special background to be great at this. The whole point is to keep the research simple, logical, and straightforward. So what do you actually need to pull this off? It really just comes down to 3 simple things. 1, you need to be able to read some basic financial statements. 2, you just need a general feel for the business and the industry it's in. And 3, basic math. Addition, subtraction, multiplication, division. That's it. I'm serious. All right, so we're all in on fundamental analysis. It's the key to building long-term wealth. But is that the whole story? Is it the only tool you should have in your investment toolkit? Well, not exactly. A really smart market strategy often uses more than just one approach. And this is where its counterpart, technical analysis, or TA, steps onto the stage. Just look at this comparison. Fundamental analysis, FA, that's your marathon tool. It's for identifying great companies to hold for years. Technical analysis, TA, is more like a sprinting tool. It's about looking at charts and patterns to time your entries and exits for quicker, short-term returns. They do 2 totally different jobs, but both are incredibly valuable. And here's the thing. The smartest people in the room, they don't pick one over the other. They use both. They use fundamental analysis to figure out what company to buy, and then they often use technical analysis to help decide when is the best time to buy it. And this leads to a really powerful way to manage your money. It's a really cool concept called the core satellite strategy. Think of your total investment money like this. The core, which is the biggest piece of the pie, maybe 60%, is for your long-term bets on fundamentally strong companies you found using FA. Then the satellite, that other 40%, is for your more active short-term trades using TA. What's super important here is that you have different goals for each slice of your portfolio. For that big core part, you're playing the long game, aiming for a steady 12 to 15% compounded growth each year. But for the satellite portion, you might be looking for absolute returns of 10 to 12% a year from your shorter trades. It's a beautifully balanced approach, right? You get long-term growth plus opportunities for some quicker wins. Okay, so you get the why, you get the how, but what about the what? What do you actually need to sit down and start doing your own fundamental analysis? Well, the good news is the tools are way simpler and easier to get your hands on than you might think. And get this, the best part is you probably already have most of what you need, and it's almost all free. The number one most important thing is the company's annual report. You can get that right off their website. You'll want to find some data about their industry, which you can often get for free too. Of course, you need to keep up with the news, something like Google Alerts is perfect. And finally, a basic spreadsheet program. That's literally all you need to do research that's on par with what the big institutions do. So, let's wrap this up. We've totally busted the myth that you need to be some kind of financial genius to do this. We've laid out a smart, balanced strategy, and we've shown you that the tools you need are simple and right at your fingertips. We've given you the entire framework. So really, the only question left to ask is, which company are you going to analyze first?